Well, first, let me start by thank you for including our papers into the program. It's a great pleasure. And in particular, we have just made a major update or revision on our paper, so it would be nice to hear all the feedback and comments. So this is a joint work with Jianlei Han from Macquarie University and Shiyang Huang at HKU. I'm Joe from Melbourne. And the title of the paper is Trust in DeFi, an empirical study of the decentralized exchange. Now, without further ado, let me share with you guys our work. So DeFi is short for decentralized finance. And DeFi in cryptocurrency has become an important fintech innovation lately. The market cap for DeFi has exceeded $100 billion in 2021, which is about 10 times increase since 2020. Proponents of the DeFi claim that the decentralized nature of the blockchain technology plus the transparent smart contracts can become a better way to organize trading. It's better because of the traditional model needs a centralized third party to organize and underwrite the system. So far, there has no clear empirical evidence on its above mentioned advantages. So what do we do? Well, we empirically compared the nascent decentralized exchange with the centralized exchange of the cryptocurrencies. We examine how the decentralized infrastructure influenced economic agents' decisions, such as trading. Specifically, we zoom into the largest centralized exchange, Uniswap, and the largest centralized exchange, Binance. And we study how investors trading responds to prices on those exchanges and how each exchange's price contributes to the equilibrium price dynamics in the market. So why are we doing so? Well, the price dynamics is important. Prices on exchange reflect investors' consensus regarding their belief of the value of cryptocurrency. Individual investors could use the prices to update their beliefs and hence make trading decisions. In some sense, our intuition is in the similar spirit of Grossman's Stiglitz, suggesting that price can be an informative signal for economic agents' decisions. Now, taking on the face value of what I have just said, it seems that our work goes along the line of price discovery in the centralized and decentralized market. That being said, we would like to emphasize an important difference between the crypto trading and the trading of the traditional financial securities like stocks. The important difference is the lack of regulation for most crypto exchanges and most crypto tradings. For the traditional financial market, regulation is very important. Regulation helps to maintain the public trust on the reliability of the price discovery process. By studying crypto trading, we'll try to basically understand how the decentralized technology, blockchain plus smart contract, can affect this price discovery process when the regulation is absent. Okay, in crypto trading, the lack of regulation makes this crypto exchange less transparent or even trustworthy. And this is more of a problem for the centralized than the decentralized exchange. Why so? Well, the decentralized exchange offers a better transparency and trustworthiness in trading on these following two aspects. First, transactions are organized through smart contracts on the decentralized exchange. Smart contracts are open to all participants, and any participant can access the code and, most importantly, the transaction data under this smart contract. Secondly, all transactions on the decentralized exchange are kind of settled on the blockchain, validated through independent nodes by proof of work. Proof of work suggests that it's very hard to falsify transactions. Both of these two features are not really governed by the centralized exchange, which creates an issue about transparency and trustworthiness. Okay. Now, all being said, ultimately, what we try to do here is basically we test if the decentralized technology is better at the price discovery in terms of revealing a consensus. A consensus is a price that investors is going to put more weight on to update their belief. And this is particularly important because we study this price discovery under the scenario of missing regulation. Okay. Now, let me quickly go through our main findings, and I think I'll go even into more details afterwards. But let me just give you a brief view of our main findings. First, we find that the size of the Uniswap user base, measured by its size of liquidity provision, influences investors' response to prices on the two exchanges. Now, when liquidity provision on Uniswap gets larger, investors on Binance become more sensitive to the Uniswap price, and they trade toward the Uniswap price. This effect is stronger among cryptocurrencies with high uncertainty and more experienced users providing liquidity on Uniswap. And we find that the cross-market arbitrage does not seem to be able to explain our findings. Why that? Well, we find that the correlation between the concurrent Binance and Uniswap investor trading, i.e. buy and sell, to be positive, the correlation to be positive when facing the same price differences at the same time. If we think the trading is still driven by cross-market arbitrage, then we should observe a negative correlation between Binance and Uniswap investor trading. Excuse me, because the arbitrage should buy low and sell high. It should be buy on one value and sell on the other value. Therefore, it should be a negative correlation, but we find the opposite. Okay. We also established the causal relation between Uniswap liquidity provision and Binance investor trading with the launch event of the yield farming program on Uniswap liquidity provision. The launch of the yield farming program is an exogenous shock to increase the Uniswap liquidity provision. Our IB results collaborate with our main findings. Last but not least, we find the Uniswap's price has a larger contribution towards the common price trend or the equilibrium price dynamics between these two exchanges, Binance and Uniswap, when the Uniswap liquidity provision increases. Okay, so those are our main findings. Now, what's the main implication from our work? We think that at a high level, we provide empirical evidences that the decentralized crypto exchange can help reach the decentralized consensus regarding the value of cryptocurrencies. And this is a case where a decentralized infrastructure overcomes the deficiency in a centralized infrastructure. And the deficiency in this case is the lack of regulation, which implies the lack of a manipulation proof price from a centralized crypto exchange, or maybe the lack of confidence that such a price can come from a centralized exchange. Of course, having more regulation of the centralized crypto exchange can kind of rebuild this trust in some sense. But we show that a DeFi application could be a valuable alternative solution. Okay. So that's our main implication. So we touched on the literature of cryptocurrencies and DeFi, and also the market fragmentation literatures in the market microstructure studies. Because of the time constraint, I'm not able to go into the detail of all these papers, but I do want to mention our discussant, Shiyang, have made an important contribution to the first thread of literature on cryptocurrencies and DeFi. So I'm really looking forward to hear Shiyang's comments. Now, before I show the main hypothesis that we're testing and the results, let me just quickly, provide a very brief summary regarding the institutional background on Uniswap, the decentralized exchange. So Uniswap is a representative of the decentralized exchange. It's an automatic liquidity protocol powered by a constant product formula that sets the price. Each Uniswap smart contract manages a liquidity pool, which is made up of a reserve of a pair of cryptocurrencies. So if you look at the graph I'm putting here, the Uniswap, the decentralized exchange in this case, is basically a Uniswap pool, which consists a pair of two tokens, token A and token B. Those are the ones we call the reserve of the tokens here. Now, liquidity providers who provide liquidity towards this pool comes into this market, deposit the pair of these two tokens into the pool. Okay, and then for the liquidity trader who just trading on the one side, they come into this pool swapping one token for another token. Okay, the price in this pool is basically set by some predetermined mathematical formulas. In this case, it's the constant product formula. Okay, so that's kind of the how, in a nutshell, how the decentralized exchange is organized. All those trading protocols are organized through the Ethereum smart contract, and the trading is actually validated through the blockchain, through the proof by the proof of work. Okay, the decentralized exchange like Uniswap has experienced a significant growth since 2020. So you can see in this graph, the trading volume of Uniswap for many of the cryptocurrencies have surpassed the Binance, which is the dark blue line here. So the red bar has surpassed the dark blue bar here. So it become quite an important trading venue in the cryptocurrencies. Okay, The data we use to test our hypothesis in this paper are coming from two different sources. First one is the Uniswap V2 data, which are hand collected through the EtherScan API. We have the price and the volume information from the decentralized market, and as well as the liquidity provision data and the liquidity providers data. The Binance data are obtained from the Geico. We look at 40 crypto pairs on both which are listed on both exchanges, and the sample period is from January 2020 to January 2021. Okay. Now, before I show the main empirical results, I would like to spend a bit more time to develop the hypothesis, to share with you guys the main hypothesis we're testing here. First of all, we focus on the Binance investor. Why? Well, it seems that Binance trading occurs a lot more often than Uniswap trading at a high frequency interval, which means the high 5-minute interval. So you can see the graph, the bar chart there. The blue lines suggest how often the Binance is trading regarding different cryptos. You can see the blue one is a lot higher than the red ones. Okay. And also another reason why we will focus on the Binance investor is because there are potential confounding factors that could drive both the Uniswap trading and the Uniswap liquidity provision of the user base. So in order to not be confounded by those other confounding factors, we're going to focus on Binance investor. But that being said, in our appendix, we did test our results on the Uniswap investors, and we find very similar results, or consistent results. Okay, so back to the Binance investors. We believe it is reasonable to assume that Binance investors trade on the difference between their belief of the crypto value mu and the price on Binance, P-Binance. The belief on the crypto's value mu is based on the weighted average of the crypto prices on these two exchanges, Binance and Uniswap, which is captured by the following formula here. Okay, and if we put these two together, it implies that the Binance trading Binance sale is going to be proportional to the difference between mu and the P-Binance, and then with some mathematical calculation, is effectively equals to the negative beta times the price difference, defined as P-Binance minus P-Uniswap. Okay, so the beta in this equation is basically the weight the investor put on the Uniswap price, informing their belief regarding the value. Okay, and we can also see from just the simple derivation there, it also captured how Binance investors trading respond to the price differences. Okay, now naturally, everyone will ask, what influences beta here? Well, in our case, we believe it's a Uniswap user base. Why? The intuition lies behind the wisdom of the crowd. When more Uniswap users are willing to trade and provide liquidity at the price P-Uniswap, the price become more informative in reflecting the user's belief on the crypto valuation, due to the law of large numbers. Okay, therefore, let me introduce you guys the main hypothesis we have in this paper. The first one, the Binance investor trading, i.e. order flow, buy minus sell, should negatively respond to the price difference between Binance and Uniswap, which is what the formula kind of show. And such a response increase with the size of the Uniswap liquidity pool, which means this such a response, the beta is going to get larger when the size of the Uniswap liquidity pool increases. Okay, we have extended hypothesis for our main hypothesis, which is saying that this same kind of argument that's not going to apply for the size of Binance liquidity. The Binance investor trading response is going to be insensitive to the size of the Binance liquidity provision. Why? Because the Binance liquidity provision is coming from a centralized venue, which is not as transparent or trustworthy compared to the decentralized venue Uniswap, powered by blockchain and the Ethereum smart contracts. Okay, so those are our main hypotheses. Now let me show you our main results. Okay, the main result coming from a very straightforward regression. We simply just regress the order imbalance on Binance, which is a Binance trading, on the price difference between Binance and Uniswap, and also the interaction term between the Uniswap liquidity and the price difference, and also the interaction term between the Binance steps and the price differences. The first thing we find is the order imbalance, the Binance trading indeed negatively associated to the price differences. And this negative response gets even stronger when we interact with the Uniswap liquidity, which means that when the Uniswap liquidity, when the liquidity provision on Uniswap increases, that negative response to the price difference becomes even more stronger. Okay, kind of suggesting that Binance investors start to lean towards the Uniswap price even more when you have when we have a larger user base on the Uniswap on Uniswap providing liquidity. Okay, now We do not find a similar effect with the Binance liquidity. As you can see, the interaction term between price difference and the Binance steps is basically insignificant in our analysis in the regression test. Okay. To complement our main study, we also look at two cross-section studies. We also conduct two cross-section studies. The first cross-section study is conditioned on intraday return volatility. We find that Uniswap's impact is more pronounced among cryptocurrencies featured with high uncertainty or high intraday return volatilities. Okay, what's the intuition? Well, high uncertainty will suggest that these are the cases when the consensus from the majority or the wisdom of the crowd effect matters the most or matters more. And that's why we find this effect, Uniswap effect, to be even stronger because Uniswap becomes an even more important venue to deliver the decentralized consensus regarding the valuation of the cryptocurrency. Okay. The second cross-section study is conditioned on the Uniswap user experience. We basically find that Uniswap impact is more pronounced among the cryptocurrencies with more experienced users providing liquidity in the Uniswap in the Uniswap pool. Okay, so both these cross-section studies seems to be telling us like beta is going to be affected by the pool by the size of the Uniswap, and it's going to be more important. This effect is going to be stronger when the uncertainty is high and when there's more experienced user providing liquidity in the pool. Okay. Now, an alternative story of what I just show you could be, hey Joe, this is just cross-market arbitrage trading, right? The reason why Binance investors respond to price difference is because they're taking arbitrages, arbitrage across the markets. Okay. Or we go, I mean, we don't have a pride on that, so that we just said, okay, if that's the case, why don't we test for that? Okay. So how do we test that? Well, we construct two measures here. The first measure is the correlation of price difference to order investment on Binance, which captures the Binance trading regarding the price difference. The second measure is correlation between price difference and order investment on Uniswap, which captures the Uniswap trading regarding that same price differences. If this is a cross-market arbitrage, what we should expect is that these two correlation measures should be negatively correlated because the arbitrager should buy from one venue and sell at the other venue at the same time facing the same price difference. But as you can see from the table, we did not find a negative correlation. And more importantly, we actually find a positive correlation, which suggests that all the discussion we just had before, like how Binance Invest Trading responds to the price differences, it's not just driven by cross-market arbitrage. It's quite likely it's driven by their learning the information from the Uniswap prices. Okay. Now, we're aware that there could be other potential omit factors or missing variables there, which could cause certain endogeneity concerns. That's why we use the launch of the yield farming program, which as a quasi-natural experiment to test the causal relation of the Uniswap's impact. The yield farming program here refers to the extra reward from the crypto issuers for providing liquidity on the Uniswap, for those Uniswap liquidity provider that they can stake their LP tokens to get extra reward. Okay, this yield farming program is kind of outside of the liquidity or the Uniswap itself. It's really kind of governed by the crypto issuers. And as we shown in the paper with the different testing, we find that yield farming indeed exogenously increase the Uniswap liquidity provision. As you can see, the treatment group, the red line, depart from the control group right after the launch of the yield farming program. Therefore, we use this yield farming program, the launch of the yield farming program, as an instrument variable to basically test our previous arguments. And we find that our IV analysis shows consistent results. The second stage of IV results on Uniswap liquidity provision basically tells us the same story, where Binance investors respond to price differences, and that response becomes even stronger when the Uniswap liquidity gets larger. Okay. Now, last but not least, I'm going to show you the results regarding the price determination. So the Binance and Uniswap in price determination. What we find is that the increasing Uniswap liquidity provision increases the Uniswap contribution towards the common price trend or the equivalent price dynamics. This is consistent with investors putting more weight on the Uniswap price when updating their beliefs, and kind of reflecting that Uniswap price as becoming an even more informative signal on the decentralized consensus regarding the value of the crypto when you have like a larger Uniswap pool or more liquidity on Uniswap. Okay, Now, how do we capture this, price contribution? We basically use this Gonzalez-Granger decomposition to get a component share that each exchange contributes to the common price trend or the equilibrium price dynamics. And in the regression, we basically look at the difference between this common component between Binance and Uniswap, and we find that that difference, decreases, suggesting that Uniswap becomes more important than Binance in terms of contributing to the common price trend when the Uniswap liquidity increases. Okay, so that's our major implication regarding asset pricing or the price dynamics. Okay, so to conclude, what we find is that when the size of the Uniswap user base measured by its size for liquidity provision increases, investors lean towards the Uniswap price. And the effect is more pronounced among cryptocurrencies with high value uncertainty, because this is when consensus from the majority matters the most. It is also more pronounced among cryptocurrencies which feature with more experienced users providing liquidity, also suggesting that price will become more and more informative given that there will be more experienced users agree on that prices. Okay. We use the launch of the yield farming program to establish the causal relation between Uniswap liquidity provision and Binance investor trading. And more importantly, we find Uniswap increases its contribution towards the equilibrium price dynamics when its user base increases. Most importantly, we'll argue that we provide empirical evidences that the decentralized crypto exchange can help reveal the decentralized consensus on the value of cryptocurrencies. This implies that the decentralized infrastructure could overcome deficiencies in the centralized infrastructure in reaching the valuation consensus. The deficiency in our case is the lack of a manipulation proof price from the centralized crypto exchange, or the lack of confidence that such a price can come from the centralized exchange. The reason of that is because there's a lack of regulation in crypto trading. Now, having more regulation could resolve the deficiency, but we show a DeFi application could be an alternative solution. I think that's the last slide I would like to share. Thank you, and looking forward to Shiyang's discussion.
Thanks so much, Zhuo. That was a great presentation. And this is an area that is quite close to my heart. I have some projects working in this area, and so it was a real pleasure to go through this paper. So I want to start with a little bit of an overview. My main takeaways were that Binance trading responds to the fundamental value that's observed on the Uniswap DEX, and that larger liquidity pools increase the price discovery or share of Uniswap, and that these pools with more experienced LPs contribute more to price discovery. I think there's a number of things that it's worth thinking about and maybe testing the robustness or why we would expect results to pop out as they do. And so I think one of those really relates to the way that we measure the liquidity pool activity or size. And if we think about the way that Zhuo explained to us, the LPs, you're effectively locking up some asset A and asset B, and then you don't have a view on the price. The price is controlled by this curve. And the way that Zhuo is measuring activity in these liquidity pools is by having a larger number of or a larger amount of value locked. And I think that this is definitely, in a traditional financial market, if we think about market makers, the more market makers we have who are actively quoting, the more depth we may have, the more, the tighter spreads we may have. But it's not clear that this same measure would be appropriate here. And so I think, it could be one single whale who has, locked $100 million into this pool, or it could be, 100,000 participants putting $1,000 each. So, I guess, one alternate way to approach your measurement here would be to, maybe use the transaction volume that's going on here, especially because DEX prices can only change with trading, right? Like, you can have more and more liquidity providers come in, but until that trading occurs, the price in that decentralized exchange really doesn't change. So maybe one way would be to look at trading volume. Maybe a different way would be to look at, the number of participants who are providing liquidity in this, in each LP. And I guess that's one component that you've started to look at in terms of the experience of those participants, those liquidity providers. So I think how you measure that LP size really becomes important, particularly for the way that the total value locked in a pool is going to impact the mechanism by which prices adjust, or the speed at which prices adjust. One thing I found a little bit confusing from the paper is the idea that around trust. And, what is it that we can trust more in decentralized exchanges that maybe we could not find in centralized exchanges? And that was something that wasn't clear to me, particularly when we think about some of the issues that are emerging in these decentralized exchanges, like front running or sandwiching, through minor extractable value, or the potential for, wash trading. Obviously, if it's wash trading from my own address to my same address, that will be visible. So you'll definitely be able to tag that as wash trading. But, if I have two addresses, I can wash trade between them in the decentralized exchange all day. And the decentralized exchange itself could have stale prices, right? If nobody trades, the price will not change, even though the fundamental value may change. And so, it wasn't clear to me, given the potentially manipulative practices that we know occur in the decentralized exchanges, what that trust factor really was. And I think if that's what the study is going to focus on, that there's more trust here, I think it's important to understand what that is. And the main differentiator I could see here is that, you can observe the trader's ID directly in the decentralized exchange, which is something that, you can't do in a Binance marketplace. But it was unclear to me if the implication then was that Binance is, actors on Binance are wash trading, or that actors on Binance, the Binance exchange itself is manipulating or, trading on the other side. It wasn't clear to me what the trust thing was that we have in decentralized exchanges that we don't have in centralized exchanges. And so I guess, if it's going to be about trust, I'm not sure that it has to be, but if it is going to be about trust, I really was a bit confused about what was the element of trust that was lacking that we now have here. Another question that came to mind, and I wasn't able to find the answer in the paper, is the issue that you have regarding a kind of discrete time and continuous time across these different kinds of venues. So if we think about a continuous exchange like Binance, there's trades and quotes, and they occur at nanoseconds whenever somebody submits them. Whereas if we think about the decentralized exchanges, you're effectively relying on the Ethereum virtual machine to act as the matching engine. And the Ethereum virtual machine at present, runs on a proof of work system, which results in a random block time. And this block time, in general, in practice, is between 1 and 21 seconds or something like that, with a target of every 12 seconds. And so let's just imagine that it came every 12 seconds. You've basically got one market that's kind of slow in the sense that it can only update every 12 seconds. And you've got another market that's very fast, that is operating continuous time. And I think it's important to be able to deal with these discontinuous time intervals in a clever way. And so, Talis Putnam's one of my colleagues, he and Jan Zivit have a methodology in terms of this price discovery measure that, may help here. But I think it wasn't clear to me in the paper if they just took, because you do have random block times, do you just take, omit all prices, all continuous prices except those that occur on the block time, or do you allow continuous prices and only take, one update from the decentralized exchange every 12 seconds? And this is going to be super important or very, it's going to have a huge influence or impact on the way that you measure price discovery shares if you've got a slow market and a fast market. So you at least need to tell me how you do that. But I think you need to be very careful about how you approach this problem if price discovery ends up being one of the key components that you're analyzing. I can show you here, this is some work. There's a number of people working in this AMM space, and this is one of my ex-PhD students who has a paper, a job market paper on automated market makers. And, here's a plot of the price on Binance and Uniswap every, 30 seconds or so. And what we see here is that these prices are relatively close, right? We're dealing here with a I think a 24-hour period, more or less. And you see that, the prices move together. There's more variance perhaps in the Binance price because obviously prices can go up, prices can go down, and the prices are updating less frequently on the primary exchange. But what this tells me is that like the prices are very close, right? Like I'm not making a determination from this about what the lead lag relationship is, but what I can tell you is that there is at high frequency good agreement between the two exchanges. What this tells me is that there is at least sufficient arbitrage activity to ensure that there is no significant deviations between the two. And I think, it's important to contemplate the way in which prices adjust. So on Binance, people can, in continuous time, submit changes to their quoted prices that they're willing to provide. In Uniswap, there is no such thing as a quoted price, or there is like a fixed ratio price that can only adjust whenever trades show up, right? Anytime there's a trade, effectively it generates a new equilibrium price. And so then, I sort of got to thinking, well, what would cross-market arbitrage look like? So, we could think about an example, time zero, Binance is $100, Uniswap's $100, the price difference is nothing. Right now, we observe an innovation. I'm indifferent to where the innovation occurs, but let's say, the price on Binance goes to 110, Uniswap's 100. Now you have a difference of $10. Now, if I think about what the kind of regressions that they're running, it's this sort of correlation between the lag of the price difference being $10 and the activity that we would expect on each venue in this scenario. And so, Binance has the high price here, $110. I'm going to sell at 110. I'm going to buy at 100. So I'm going to have sort of negative volume or selling volume happening on Binance with a positive price difference, and I'm have positive on Uniswap. And I guess what this generates is this kind of negative relationship that's observed between lag price differences in Binance and a positive relationship with Uniswap. And so I guess it's important, to think about, or as Zhuo has done, he's gone some way to trying to convince us that it's not arbitrage, but I guess I'm just not 100% convinced. And I think if I now consider the nice IV that we use, which is to say, okay, there's this situation of yield farming that encourages a significant increase in the size of liquidity pools. That's a really nice event. But I pulled this graph from their paper, and you can find similar in other AMM papers. And what it demonstrates is how the price will change for a given transaction in different sized pools. And what we see is this, this green pool is the smallest pool, and the red pool is the largest pool. And what we get is that, the different sizes of the pools, the larger is the pool, the slower is the price adjustment, or the more dollar volume needs to go through that pool to actually adjust the price. And so if I think about how this works from an arbitrage perspective, the more liquidity there is in a specific pool, the larger are the potential arbitrage opportunities, and the more dollars it takes to actually adjust the price in the liquidity pool. And so what we would expect is that larger liquidity pools will facilitate more arbitrage, in the sense that those larger pools require a larger investment of dollars to adjust the prices. And so this increases the amount of arbitrage activity that could go on, providing more opportunities for cross-market arbitrageurs. And so I'm not sure exactly how we overcome this mechanical potential kind of endogeneity. I mean, yield farming does increase the TVL, but that also, it's not clear to me if that will mechanically increase the information share. So I think you just need to be careful about the mechanism by which pool size impacts the price changing process. And maybe that's one reason to use different measures, like the number of LPs or the trading volume in those liquidity pools. So what do we observe and what can we say? Well, I think price discovery is something that's clear and can be measured. There are difficulties around the different speeds of the markets. But being able to tell us where price innovations are created and whether these new styles of venues are kind of leading or lagging, I think could be interesting and useful. And what I would really like to see the authors focus on is, well, what does that tell us about the role of the decentralized exchange? What does that help us learn about why people use it? Maybe you can do some digging about, to what extent do we see the same traders or arbitrageurs, right? Like you see all of these, one of the unique features, if we think about what's different here, is that we can actually see who trades everywhere. And so maybe looking for those individuals who are, I use decentralized exchanges, but I might have used them 10 times in my life, and I've always used the same ID. But an arbitrageur is going to need to use them like hundreds of times a day, right? So you're going to find these individuals, you're going to be able to identify them at least from the DEX side. And so maybe there's something interesting that you can say about, user behavior or the way in which these things, why people use them, I think is maybe something that's interesting. Whether we can assign any of these activities to like trust, or maybe, there's alternate reasons that people use these mechanisms, I think that's, that's something the authors really need to focus on. But otherwise, I thought it was a really, really great to just see work in this space, right? It's a very interesting and evolving space, moving very fast. So it was a real pleasure to read the paper.
Thank you
for it.
Thanks,
Thank
Sean.
you for this.
So should I just go and respond now? Or? Okay.
Okay.
So
do you want to respond to Sean's questions or comments there?
Yes, I may just quickly respond to some of the comments Sean made, and I think my co-authors are also in the on the Zoom. If they would like to jump in, it might be also be helpful. So Sean, thanks a lot for the discussion. I think it's very helpful. Regarding your first point of the number of participants, that's actually we have done a robustness test on that, and the results still go through. But we need to clean up a little bit to include that in the updated draft. But you are exactly on the mark. Like the liquidity provision is one proxy for the user base. The adoption of Uniswap, number of participants will be another measure to capture the similar information. I like what you mentioned about the trust factor related to the learning. I think that's I agree. That's something we will we need to put more emphasis and think carefully about. And that's going to be important to unveil the importance of the decentralized exchange. In terms of the price discovery, so I think two things I would like to clarify. First, we use the volume weighted traded price. So it's not really a quote. It's not really a mid quote regarding the price discovery. So that's a slightly different. And the second thing is like regarding the arbitrage activities. So as you have mentioned, like if there's an arbitrage, then the trading should become happening quite frequently, which we didn't see that in the data. We see that the most of the traders on the decentralized exchange are actually relatively inactive compared to our high frequency kind of norm. So that's why we're kind of very convinced that this is not just arbitrage. We're not saying there's no, just probably this is not a major driving force for how investors respond to price differences. And the other thing I would like to also point out, like arbitrage could be one channel to close the price on a fragmented market. Learning could be another way to close this gap. In the sense that Binance investors simply observe the Uniswap price and decide to put more weight in their valuation of the crypto, and then change their trading behaviors on the Binance on Binance. That itself can kind of the learning channel itself can make sure these two markets kind of be in check. But all being said, I think the discussion is very great. I mean, I'll be happy to have your slides. Yeah, and yeah. So So if my co-authors would like to jump in, feel free to jump in anytime.
There's also a question in the chat window too.
Yeah, so I think maybe Shiyang will have something to add on to what I just said.
Yeah, sure. I like your comment on the cost arbitrage. So this is our understanding. So we need to differentiate between cross-market arbitrage and just investor learning behavior. We can understand in this way. When investors are doing a cross-market arbitrage, they need to trade on both exchanges. But actually, if investors are learning, for example, they just trade on the difference between their belief and the price. We can also create, correct mispricing correction, or we can say just arbitrage, or just do some speculation, right? So probably here we are on the same line. To be honest, we just want to differentiate cross-market arbitrage, or investor just trading on the difference between their belief and the price on their specific change. So let's say that. Okay.
So let me just quickly respond to the comment raised by Bofu on the chat. So the question is, how did you deal with the gas fee index and wash trade in Binance? Well, short answer, we can't deal with wash trading in Binance. I don't think there's a good way to deal with that. So we know there's an issue there, and that's one of the reasons why we consider Binance to be, really kind of issue in terms of how investors should learn, because we don't even know if the volume is a real volume in some sense. And the second point, an investor group between Binance and Uniswap will be very different. We have a robust exchange looking at the Uniswap traders who interact with Binance, given that they have been deposit their tokens into the Binance API, and we find the result to be similar. In other words, if the results are driven by the group characteristics, we don't find a supporting evidence on that. Okay, so that's my response.
But related to Bofu's comment, I want to add something here. So actually, watching trading on finance is our motivation to study the decentralized finance. So actually, this is our argument here. We can imagine there are a lot of issues in the current centralized crypto exchange, such as watch trading or manipulated prices. So this is the reason why we observe finance trading is not related to the finance liquidity provision. Thank you.
Thank you.
Thank you, Zhuo. Thank you, Shiyang. Thank you, Sean. Okay, and so we'll have. There's another question. Do you want to respond to that, Zhuo?
So have you looked at so the question is, have you looked at the difference in fee for each Uniswap pool does affect? So I suppose the question is asked about the difference in fee for each different pair of tokens in the Uniswap pool. So we control for crypto pair of fixed effect, so that which means the result is not driven by certain outliers in the sample.
This is also related to our identification strategy, right? Because we use your farming program.
Yeah.
The launch of your farming program is to encourage liquidity provision. So we just take advantage of this kind of event to pin down the causal link here. So if we think this is a general difference in the fee or just the liquidity provision, actually we observe fat trading activity.
I think we use only the Uniswap V2 liquid pool, so all the pools have the same fee, 0.3%. So we're not Uniswap V3 may introduce different fees, but the data period we use is focusing on the Uniswap V2.